there is a question that every airline analyst, every aviation investor, and every CEO at United and American has been asking for years. How does Delta do it? How does an airline that pays its employees more than its competitors, operates aircraft that are on average older and less fuel efficient than United's, and flies a smaller international network than both of its major rivals? How does that airline consistently generate more profit than the other two combined? The answer is not magic, it is not luck, and it is not the result of any single advantage that can be easily copied. It is the result of a revenue architecture that Delta has been building for 15 years, an architecture so comprehensive, so interlocking, and so deeply embedded in the airline's operations and culture that it has created what may be the most durable competitive moat in American aviation. History. Delta Airlines delivered record annual free cash flow of $4.63 billion in 2025 and provided confident guidance for 2026, projecting earnings per share between $6.50 and $7.50. Big Go Finance free cash flow, not accounting profit, not adjusted earnings, actual cash generated above and beyond all capital expenditures, the money that an airline has left over after paying for everything it needs to operate and grow. $4.643 billion. In a year when American earned $111 million total, in a year when the industry faced government shutdowns, fuel price volatility, air traffic controller shortages, and geopolitical uncertainty that affected every carrier equally, Delta generated nearly $5 billion in free cash flow, while American generated barely enough to cover a rounding error. That is not a competitive gap. That is a competitive chasm. Delta Airlines is currently the market's leader in terms of premium mix and diversified non-ticket economics. The airline's outsized co-branded card deal with American Express and high penetration of premium markets make it a powerful player in the industry. The carrier's rapidly growing third-party MRO presence remains robust, and it has continued to maintain high and rapidly expanding profit margins. Simplifying the phrase diversified non-ticket economics is the key to understanding Delta's profit advantage. Delta is not primarily an airline that makes money selling plane tickets. It is a diversified travel and loyalty company that happens to operate an airline. The distinction sounds subtle. The financial implications are enormous. Start with the American Express partnership, because this single relationship may be the most important financial asset in the U.S. airline industry. American Express remuneration to Delta grew 11% in 2025 to $8.2 billion, driven by double-digit growth in co-brand spend in each quarter, with more than 1 million new card acquisitions for the fourth consecutive year, $8.2 billion, from credit card fees, from the margin that American Express pays Delta every time a SkyMiles cardholder uses their card anywhere in the world. When a Delta loyalist buys groceries, fills their gas tank, pays their utility bills, or shops online, Delta earns money. No aircraft, no fuel, no crew, no gate, just revenue flowing from a financial partnership built on the loyalty of premium travelers who trust the Delta brand, enough to put it on their wallet. In 2024, Delta paid $747 million in interest expenses, United paid $1.6 billion, and American paid $1.9 billion. 1 mile at a time, this single number explains a significant portion of the profitability gap. Delta's investment-grade credit rating, maintained through years of disciplined balance sheet management, means it borrows money at lower rates than either competitor. Every dollar that American pays in interest above what Delta pays for equivalent borrowing is a dollar that American cannot invest in fleet modernization, cabin upgrades, lounge improvements, or technology. The debt burden is not just a financial constraint. It is a competitive tax that American pays on every strategic investment it tries to make. Then there is Delta's MRO business, Delta TechOps, which has become one of the largest and most profitable airline maintenance operations in the world. Delta's in-house MRO division, Delta TechOps, plays a key role in efficiently managing the complexity of its diverse fleet, while also generating revenue, servicing aircraft and engines for other airlines. Wikipedia. Delta doesn't just maintain its own aircraft, it sells that maintenance capability to other carriers, generating hundreds of millions of dollars annually in revenue from a business that United and American have never fully developed at the same scale. Delta turned a cost center into a profit center, and the profits from TechOps flow directly to the bottom line. subsidizing the cost of maintaining Delta's own fleet in ways that competitors who outsource their maintenance cannot replicate. Morningstar equity analyst Nicholas Owens noted that United and Delta are way out in front in attracting high-spending passengers, both leisure and business. Marketplace. This premium revenue concentration is the third pillar of Delta's profit architecture. Premium cabin revenue, business class, first class, premium economy, generates margins that economy seats simply cannot match. A Delta One seat on a transatlantic flight might generate $3,000 to $5,000 in revenue on a single flight. An economy seat on the same flight might generate $400 to $700. Delta has systematically shifted its revenue mix toward premium cabins over 15 years, investing in the aircraft, the products, and the brand credibility that allows it to fill those seats at premium prices on routes where competitors are discounting to compete on price. Delta's focus on international travel and premium cabins has led to strong demand for business travel and high brand loyalty, resulting in its financial performance ranking at the top of the industry. Airlines. The operational dimension of Delta's profit advantage is perhaps the most underappreciated. Delta consistently ranks at or near the top of U.S. airline on-time performance. Its irregular operations recovery, how quickly it gets passengers to their destinations when flights are disrupted, is acknowledged across the industry as best. Its customer service culture generates loyalty that shows up not in survey data but in booking behavior. In the premium traveler, who has a choice of 3 airlines on a given route and chooses Delta without checking the price, that kind of loyalty is worth billions in lifetime customer value, and it is built, day by day and flight by flight, by an operational culture that United is working hard to match and American is working to rebuild. The real reason Delta's profits are destroying United and American is that Delta doesn't just compete better in any single dimension of the airline business, it competes better in every dimension simultaneously: premium revenue, loyalty economics, MRO revenue, cost structure, operational reliability, and balance sheet strength, and the advantages in each dimension reinforce all the others. A stronger balance sheet means cheaper capital for fleet investment, which generates better products, which attracts premium travelers, which drives loyalty program engagement, which generates more American Express revenue, which strengthens the balance sheet further. It is a flywheel, and Delta has been spinning it for 15 years. United is building its own version of that flywheel, with genuine success. American is trying to find its flywheel, and until one of them builds something comparable, or until Delta makes a strategic mistake large enough to interrupt the compounding, the profit gap will remain the defining story of American aviation. There is one dimension of Delta's profit architecture that almost never gets the attention it deserves, and it may be the single most unusual competitive advantage possessed by any major airline in the world. Delta owns an oil refinery, not a financial stake in a refinery, not a hedging contract with a refinery, an actual, physical oil refinery, Monroe Energy's Trainer Refinery, near Philadelphia, that Delta acquired in 2012 and has operated ever since as a subsidiary. Delta's subsidiary Monroe Energy operates the Trainer Refinery near Philadelphia, giving it partial insulation against refining cost surges that hit fully unhedged carriers. Deutsche Bank analyst Michael Lindenberg said Delta is best positioned to navigate through a higher fuel price environment, given its diversified revenue streams and investment-grade RATED balance sheet, TIKR, when fuel prices spike, as they did after Russia's invasion of Ukraine, as they are doing again in 2026 due to Middle East tensions. Every airline faces higher costs, but Delta faces those higher costs differently from United and American. When the gap between crude oil prices and refined jet fuel prices widens, the cracks spread in industry terminology. Delta's refinery generates profits that partially offset the higher fuel costs hitting its flying operations. The refinery saved Delta over $1 billion in fuel costs in 2022 and 2023 after Russia invaded Ukraine, and the same dynamic is playing out again as global fuel and refining capacity are under pressure. Live and Let's Fly United and American have no equivalent protection. Every dollar of increased jet fuel prices hits their cost structure directly, with no internal offset. Delta has a structural fuel cost hedge that its competitors cannot replicate without buying their own refinery, which no other airline has done. because it is an